What if I told you that the world's most successful investor just quietly shifted $94 billion out of the market, and almost nobody noticed? Warren Buffett didn't announce it. He didn't hold a press conference. He didn't write an op-ed explaining his reasoning. He simply executed the largest cash position in Berkshire Hathaway's history while the rest of Wall Street was celebrating new highs. $94 billion sitting in treasury bills. Not deployed, not invested, not chasing returns, just waiting. And if you think that's a coincidence, you haven't been paying attention to how Buffett actually operates. Because here's what most people miss about Warren Buffett. He doesn't move early, he doesn't speculate, he doesn't position for possibilities. And when Buffett moves capital on this scale, it's not a hedge, it's not a cautious adjustment, it's a mathematical conclusion. And the conclusion he just reached should terrify you. Not because he's panicking, but because he's done the math. And the math says something in the American financial system is fundamentally mispriced. Let me show you what Wall Street doesn't want you to understand about this move. For decades, Buffett has operated on one core principle that separates him from every other investor on the planet. He doesn't buy stocks. He buys value. And when value disappears from the market, he doesn't pretend it's still there. He stops buying. Completely. And that's exactly what just happened. Berkshire Hathaway, the company that built its empire by finding undervalued American businesses, just looked at the entire market and said, "There's nothing here worth buying." Think about that for a second. The man who spent 50 years telling people to buy America, to bet on American ingenuity, to trust in long-term compounding returns, just pulled $94 billion off the table. And he did it quietly, methodically, while everyone else was still partying. Now here's where it gets interesting. Buffett didn't just sell stocks and sit in cash waiting for a better entry point. He moved that capital into short-term treasury bills, not long-term bonds, not corporate debt, not dividend-paying blue chips, treasury bills. The shortest duration, most liquid, most defensive instrument in the financial system. And there's only one reason you make that move at this scale. You're not waiting for a dip. You're preparing for a collapse. But to understand why, you need to understand what Buffett sees that the rest of the market refuses to acknowledge. And it starts with valuation. Right now, the S&P 500 is trading at price-to-earnings ratios that have not been sustained outside of two periods in modern history: the dot-com bubble and the months before the 2008 financial crisis. Both times, the market told itself a story. Both times, that story ignored basic mathematics. And both times, the people who saw through the narrative early were the only ones who survived what came next. Buffett is telling you, without saying a word, that we're in the third chapter of that story. Except this time, the imbalances are bigger, the leverage is higher, and the exit doors are narrower. Let me show you the numbers Wall Street doesn't talk about. Corporate profit margins in America are at the highest levels ever recorded. Not just high, the highest, ever. And that's not because American companies suddenly became more efficient or more innovative. It's because they've spent 15 years borrowing cheap money, buying back their own stock, and inflating earnings per share without actually growing revenue. It's financial engineering. And it works beautifully until it doesn't. Because here's the thing about peak profit margins. They don't stay at the peak, they revert. Always. It's not a theory, it's gravity. And when they revert, earnings collapse. And when earnings collapse, stock prices don't gently decline. They gap down, fast. And the people holding those stocks don't get to exit in an orderly fashion. They get trapped. And Buffett knows this. He's seen it before, multiple times. And every single time, the market told itself it was different. Every single time, the institutions insisted that old rules didn't apply anymore. And every single time, mathematics won. So when Buffett moves $94 billion into treasury bills, he's not being cautious. He's being correct. And the scariest part? He's not done. Berkshire is still selling, still raising cash, still exiting positions that the rest of Wall Street is buying. And that divergence should tell you everything you need to know about what's coming. But there's a second layer to this that almost nobody is discussing. And it's arguably more important than the valuation problem. It's the liquidity problem. Because Buffett didn't just move into cash. He moved into short-term cash. The kind of cash that can be deployed instantly. The kind of cash that doesn't lock you into a duration or a maturity date. The kind of cash you hold when you expect forced sellers to flood the market with assets at fire sale prices. Think about what that implies. Buffett isn't preparing to buy the dip. He's preparing to buy the liquidation. The moment when hedge funds have to unwind. When pension funds have to meet redemptions. When margin calls cascade through the system and prices no longer reflect value, they reflect desperation. That's the moment Buffett is waiting for, and he's positioning $94 billion to capitalize on it. Now let me show you why this isn't just about stock prices. Because if this were just an overvalued equity market, Buffett would rotate into other assets, commodities, real estate, foreign equities, anything with relative value. But he didn't. He went to cash. And that tells you he thinks the entire system is mispriced, not just stocks, everything. And here's why that matters for America. Because the American economy for the last 15 years has been running on one fuel source: asset price inflation. When stock prices go up, people feel wealthier. They spend more, they borrow more, they invest more. And that spending drives GDP growth, it drives corporate earnings, it drives tax revenue. The entire machine runs on the assumption that asset prices keep going up. And the moment that assumption breaks, the machine stops. And Buffett just bet $94 billion that the assumption is about to break. Let me show you what happens next, because this isn't speculation, this is sequence. First, liquidity dries up, not because the Fed stops printing money, but because banks stop lending. Because when asset prices start falling, collateral values decline. And when collateral values decline, loans get called. And when loans get called, forced selling begins, and forced selling creates more price declines. It's a loop, and once it starts, it doesn't stop until something breaks. Second, earnings disappoint, because when consumers feel poor, they stop spending. And when they stop spending, revenue growth stalls. And when revenue growth stalls, those inflated profit margins collapse. And suddenly, companies that were trading at 30 times earnings are trading at 30 times earnings that no longer exist. The multiple doesn't save you. The denominator destroys you. Third, narratives flip. Right now, Wall Street is telling you that AI is going to change everything, that productivity gains are going to justify current valuations, that we're in a new paradigm. And maybe they're right. But Buffett doesn't invest in paradigms. He invests in cash flows. And cash flows don't care about narratives. They care about revenue, costs, margins, returns. And right now, those fundamentals don't support the prices people are paying. And here's the part that should keep you up at night. Buffett isn't the only one who sees this. He's just the only one with the courage to act on it. Because when you manage other people's money, you can't afford to be early. If you sell in 2024 and the market goes up another 20% in 2025, you get fired. Your clients leave. Your career ends. So you stay in, you ride the bubble. You tell yourself you'll get out before it pops. And you won't. Because nobody does. But Buffett doesn't manage other people's money. He manages his own. And that gives him the freedom to be right instead of comfortable. And right now, being right means sitting in cash while everyone else chases returns that no longer exist. Now let me address the question everyone is asking. If Buffett is so bearish, why isn't he shorting the market? Why isn't he buying puts? Why isn't he making a leveraged bet against the system? And the answer is simple, because Buffett doesn't need to. He's not trying to profit from the collapse. He's trying to survive it and then buy what's left at 20 cents on the dollar. That's the move. That's always been the move. You don't short bubbles, you wait for them to pop, and then you buy the assets that got thrown out with the bathwater. And $94 billion buys a lot of bathwater. But here's what makes this moment different from every other time Buffett has gone to cash. The scale. In 2008, Berkshire had about $20 billion in cash. That was massive at the time. It let Buffett step in and save Goldman Sachs, Bank of America, and half a dozen other institutions that were on the brink of collapse. And he made a fortune doing it. Because when you're the only one with liquidity in a liquidity crisis, you get to name your price. Now he's sitting on $94 billion, more than 4 times what he had in 2008. And the only reason you build a cash position that large is because you expect the opportunity set to be 4 times bigger, or 4 times worse, depending on how you look at it. And that brings us to the real question. What does Warren Buffett know that the Because here's the thing about crashes. They don't happen because something breaks. They happen because people realize something was already broken. The subprime mortgages were bad in 2005, but the market didn't crash until 2008. The dot-com companies were worthless in 1998. But the market didn't crash until 2000. The break happens first, the recognition happens later. And Buffett is telling you, with $94 billion, that the break already happened. You just haven't recognized it yet. And when you do recognize it, it'll be too late. Because by then, the selling will have started, the liquidity will be gone, and the only people left with capital will be the ones who saw it coming. So here's what this means for America. It means the next 12 to 24 months are going to redefine wealth in this country. Not because of inflation, not because of war, not because of politics, but because of mathematics. The math of overvaluation, the math of mean reversion, the math of forced deleveraging, and math doesn't negotiate. Buffett just made his move. $94 billion says he's done buying America at these prices. And if the greatest investor in history is stepping back, maybe you should ask yourself why you're still stepping forward. The math is already locked in. Physics doesn't negotiate. And the people who understand this will be the only ones standing when the dust settles. So let me ask you this. If Warren Buffett is sitting on the largest cash position in Berkshire's history, what do you think that means for the market over the next 2 years? Drop your answer in the comments. I want to know if you see what he sees.